A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The 16th largest bank in the U.S., the biggest one for startups, and the second biggest bank collapse since 2000 just happened. It was Silicon Valley Bank, and they are effectively done. So today I'll explain what happened and why, and where this could possibly lead. I know I'm a bit late to the party on this, but before we get into the changing by the minute situation that's taking place, we have to go backwards, all the way back to the start. Founded in 1983, Silicon Valley Bank grew to be a large bank specializing in venture capitalism. Whereas other big banks were more cautious about handing out loans to small startups they didn't understand, SVB took pride in making this industry their primary business. Fast forward to before the pandemic, SVB had $60 billion in the bank, so they were no small beast. Having been through a few economic recessions before the pandemic, they were ready to face the worst and walk away. They were not ready for what actually happened next. Stocks crashed and burned in March of 2020, but then something amazing happened for the bank. Government interest rates dropped to zero, and venture firms poured money into the bank, totaling $200 billion in deposits at their peak to be exact. SVB had all that cash on their hands, but not enough customers to loan out a mortgage or something like that, which another bank might try. So instead they went for the safest play possible: treasury bonds, specifically long-term treasury bonds. That long-term part will be important later. The key here is that they chose to buy these bonds when interest rates were low, kind of close to 0%, meaning they weren't going to be worth much if those interest rates rose. Before we go any further with SVB, I just want to quickly explain the bond market, as it will be important for contextualizing what happens next, though I'll probably make another video on bonds more deeply. Basically, if interest rates rise on bonds after you already bought your low interest bond, your bond becomes worth less. For an example, why would I pay you $100 for a bond that doesn't pay me interest when I can buy a bond for $100 that pays interest right now? Therefore, your old bond, you have to sell that to me for cheaper, say $90. This is what happened to SVB. As you all know, inflation rocked the US economy in the summer of 2022, forcing the government and Fed to start taking aggressive action and aggressively raising interest rates, meaning the bonds were suddenly valued less. And to be clear, this isn't just an SVB problem. This was a problem for every single bank, and they're still feeling it even now. Remember before how I mentioned those were long-term bonds? The reason that matters is because long-term bonds are more drastically impacted than short-term bonds, meaning these bonds are hurting even more than the short-term bonds, which were still down, by the way. Now you might be asking yourself, why would the bank buy these low-interest bonds if they were sure to go up, since that's the only place they could have gone from their rock-bottom position? The answer is not so simple. While in the aftermath, people are calling it a failure of risk management, which it certainly was, in theory, this could all have been a profitable transaction for the bank. You see, even though their bonds were worth less than what they bought them for, at the end of the term, they would still receive all the money that they were promised. All they had to do was make it to the end of that term. Remember what I said about that long-term thing? Yeah, they didn't make it long-term. When SVB put out their Q4 reports, Moody's stated that SVB was at a high risk of a downgrade because of their unrealized loss. This essentially meant that they were a riskier bet than before, which was just a sign of a brewing storm. But as mentioned before, they could still ride this out and walk away unscathed. The problem was that the Fed began raising interest rates, and when that happened, venture capitalism started to feel the burn. The mortal enemy of venture capitalism is high interest rates, because small ventures rely on loans, and they don't want to get a loan with a high interest rate. That meant that clients and venture capital firms began trying to get their money out of SVB, and I mean a lot of clients. The problem? SVB's money was mostly tied up in these bonds that were worth less than what they paid. In order to give back everyone the cash they requested, SVB had to sell a lot of their bonds at a loss of $1.8 billion, realizing that massive loss they had thus far avoided. The next day, they sought to raise $2 billion in capital to shore up their balance sheet. Did that happen? Well, no, of course not. Here we are. Instead, their stock price began to tank as venture capital firms told their companies to get money out of SVB as quickly as possible. As reports of people pulling money circulated, more people tried to get their money out, leading to a bank run and preventing that capital raise. In the span of 44 hours, one of the biggest banks in the US collapsed. That doesn't happen. The joke is always that banks are the last guys standing, but here we are. Enter the FDIC. No, it's not some sort of secret government research program. It's actually a great program. The FDIC was established in the 1930s to restore American trust in the banking system. Essentially, anyone that has a bank account is insured up to $250,000, which is great for normal people like you and me. The FDIC immediately stepped in as the bank run got bad and took over the bank. The FDIC promised investors their $250,000 back per account, but what would happen with the rest of the money was anyone's guess. The problem was that over $151 billion of the estimated $175 billion in SVB client money was uninsured, falling outside the range of that $250,000 limit. However, the FDIC actually stated that all uninsured money would be made available by this past Monday as well, in order to make sure faith was restored in the banking system. That was the hope, at least. In addition, HSBC in the UK agreed to purchase the UK subsidiary of SVB, which is a good sign for now. As of right now, when I'm writing this, that's where we stand. So let's talk about the fallout. Bank stocks, especially regional banks, have been hit hard since the collapse of SVB. Signature Bank, another regional bank located mostly in New York, was also seized by the FDIC due to a similar bank run, representing the third largest bank collapse since 2000. That means that the second and third worst bank collapses came within a week of each other. First Republic also saw a massive drop, even having their stock trading halted to prevent an even worse collapse. Luckily, as of right now, it seems they'll be all right, as many of the larger banks have pledged $30 billion to help the bank out. Banks had already been struggling, but now with the increased uncertainty and scrutiny, it will be critical that banks and regulators alike navigate these waters carefully. Besides the financial fallout, the political debates and conspiracies that come with every major collapse or fraud have been flowing hot and heavy. The debate over whether banks should be bailed out was of particular concern as the SVB run went down. Although for now, it seems like the government won't be putting any of the cost on the taxpayer, as far as we know. What is clear, though, is that the cracks are finally beginning to show from the aggressive Fed interest rate hikes, which might push us to the worst-case scenario of a hard recession landing. Others have stated that SVB execs knew this was coming and sold off shares of the company, which will certainly be investigated in the aftermath of this situation. The situation continues to change hour by hour, with banks across the US and the globe having difficulties. During these hectic times, I'll be sure to have as many updates as is reasonably possible. You may have noticed I didn't mention the Credit Suisse situation today, and that's because they've been so amazing at being terrible that I'm saving these lovable losers for a video this upcoming Friday, and believe me, I've got a lot to say about those folks. So be sure to subscribe so you don't miss out on that.